Welcome to The Explainer. Today, we're going to dig into the latest quarterly results from Mapletree Industrial Trust, or MIT. And, when a big real estate investment trust like this drops its numbers, people really sit up and take notice. This quarter, there's one key metric that has absolutely everyone talking.
Okay, so let's get right into it. The big headline that's grabbing all the attention is that investor payouts, their distributions, are down. Now, on the surface, that's never what you want to see, but as always, the real story isn't just what happened, it's why. So we're going to unpack exactly what's behind this drop and what it really means for their game plan moving forward. All right, first things first, let's just ground ourselves in the actual data. Before we can get into the strategy and the why, we need to understand the problem as it was reported. What's the number that's causing all this buzz? And here it is. The distribution per unit, the DPU, fell to $3.18. Now, you compare that to the $3.37 they paid out in the same quarter last year, and yeah, that's a 5.6% drop. For an investment that's all about income like a REIT, any dip like that is going to get noticed fast. And just for a quick refresher, for a lot of REIT investors, the DPU is pretty much the most important number there is. It's basically the profit the trust makes, all packaged up and paid out to you, the investor. Think of it as the cash that lands in your pocket for owning a piece of their properties. Its stability and its growth, well, that's the whole point. Okay, so this is where it gets really interesting. That 5.6% drop, it absolutely does not tell the whole story. It's kind of like reading a clickbait headline without ever opening the article. So let's get into the why and find out what's really going on behind that number. And boom, this slide really lays it all out. The biggest factor here is that last year's numbers got a big boost from a one-off gain when they sold a property. So if you strip that out to get a real apples-to-apples comparison of how the business is actually doing, well, the drop was much smaller, only 2.2%. Now, that context is absolutely critical. It completely changes the story from a big drop to a much more modest dip. So here's the deal. Even that smaller 2.2% dip didn't happen because of just one thing. It was more like a perfect storm of a few different pressures hitting all at once. First, they sold a few more properties in Singapore, so naturally the income from those is gone. Second, their properties in North America had a few more vacancies, so less money coming in from there. Third, the US dollar got weaker, which means the profits they made in America were worth less when they brought them back to Singapore. And finally, higher interest rates meant their partners in joint ventures had to pay more for loans, leaving less cash to go around. It was a real multi-front challenge. And those issues in North America, they carry a ton of weight. Why? Well, because nearly half of the trust's entire $8.5 billion portfolio is right there. So that means things like a few vacancies in the US or a dip in the dollar, well, they have this huge outsized impact on the whole company's bottom line. This isn't just a Singapore-based story anymore. It's truly a global operation. But this is where the story really takes a turn. Because what might look like a negative thing, selling off properties that are making you money, was actually part of a very deliberate, very strategic plan to make the whole company stronger for the long run. And the CEO herself, Lily, said as much. She framed that big sale of 3 Singapore properties, we're talking over $500 million, as a move to create financial flexibility. It wasn't about getting smaller, it was about reallocating their capital. In other words, they were building up a war chest to go after new opportunities down the road. And they didn't just let that cash sit around. They put it to work immediately. And what did they do with it? They paid down debt. This had a direct and really positive impact on their balance sheet. And let's be honest, in the kind of high interest rate world we're all living in right now, that is a very, very smart move. Let's take a look at the before picture. Back on June 30th, before they completed the sale, their main debt level, what's called the aggregate leverage ratio, was sitting at 40.1%. And here's the after. By using that big chunk of cash to pay back loans, they brought that ratio all the way down to 37.3% in just one quarter. That is a really significant drop in a very short amount of time. So why does that matter so much? Well, a lower leverage ratio means you have less debt compared to the value of all your stuff. It's like paying down your mortgage. You suddenly have a lot more financial breathing room. It signals to investors that you're stable, and maybe more importantly, it gives you the firepower to borrow more money for smart acquisitions when the right deal comes along. It's a classic case of taking one step back to take 2 steps forward. And they're not just playing defense with their finances. They're on offense, especially in North America. They've got this really clear 3-pronged approach: reletting, repositioning, and rebalancing. They're working hard to fill up empty spaces, making their existing properties more valuable through redevelopment, and selling off assets that don't fit the long-term plan, just like they did with the data center in Georgia this quarter. Okay, so they've got a stronger balance sheet, which is great, but the economy is still pretty choppy out there. So what does the road ahead actually look like for them? Well, it looks like a mix of facing some real challenges while riding some incredibly powerful trends.
You've got this classic push and pull situation. On one side, you have these major headwinds pushing against them. The global economy is wobbly, inflation is driving up their operating costs, and they know their borrowing costs are going to rise. But on the other side, they have this massive tailwind at their back, the absolutely explosive, unstoppable demand for data centers. I mean, get this, 74% of all new data center space being built in North America is already leased out before the doors even open. That's just incredible demand.
And this is where MIT's entire strategy just snaps into focus. They are betting big, and I mean big, on that data center tailwind. Just look at this. Data centers now make up almost 60% of their entire portfolio. This isn't just a part of their business anymore, it is their business. They've basically transformed themselves into a data center company.
This strategic pivot is everything for them. You know, with the rise of cloud computing and now the explosion of AI, the world's hunger for data storage and processing power is just insatiable. So by focusing their entire portfolio here, MIT is positioning itself to ride that massive wave of growth, and they're hoping it'll be more than enough to offset the headwinds in the broader economy.
And so that's where we land. It all comes down to this one big question for investors. Management has made a very clear, very bold strategic choice. They've cleaned up the balance sheet, and they have doubled down on the high-growth data center sector. The question now is, in this tough, uncertain economy, will that big bet be enough to power through the headwinds and get them back to the kind of sustainable growth investors are looking for? That is the story to watch.